All right, guys, this will be the fifth entry to the Trading Journal series. It's a little early right now. It's even before the New York session, so um, I'll probably post a follow-up video to this trade, just kind of documenting how it plays out during the New York session. Right now, I'm in a long position, but I want to provide a little bit of context for or justification for being in a high time frame position. So right now, I'm at the on the 7 day, which is essentially a weekly chart. Um, Obviously, we're coming down here to this support level marked by this summer consolidation on the macro. Price comes down, hits it, comes up, comes back down, rallies off. Now let's go down to a daily chart. We have this level here where structure was initially broken on the daily. Um, so price is in this very distinct trending mode, uh, basically forming lower highs and lower lows until February 4th. Price breaks up, runs these highs, comes back down, never violates these ultimate lows set in there, rallies back up, takes out these highs, rallies back or falls back down. So that's a little bit of the high time frame context. Now I did try to grab a short on this here after the break of these highs, looking for this um, inefficiency to get filled. I ultimately ended up getting stopped out on that attempt, but that's okay. Just move on to the next trade. So right now I'm in this long position, and kind of the idea that I'm basing off here is that we have this we have this very significant level right here. Um, maybe you're looking at this level, maybe you're looking at the ultimate lows, but you have this very distinct expansion in volatility, this very distinct range expansion. If you were to put volume on your chart, you'd be pretty sure that this is where volume started to come into the market, bids start entering the market, and price moves aggressively away from that level. So we know, if price returns to that level, that it's going to offer a response. You see right here. Let's see. So I took a few scalps off this level. But yeah, you have your reaction here. A little move up, comes down, come up. So you see, like, price comes down to this level, offers a very small reaction, and then it sort of works a little bit. Um, but you still have this low time frame downtrend essentially on the low time frames until you get to this area here. This is very important. So price hits this level of interest, but it's still making lower lows on the hourly chart, right? And still sort of running this orderly hourly downtrend, which is very tradable too. I mean, you could have, you draw a 618 retracement over this, and you could do the same thing essentially with, this move right here. But the idea is you have this hourly downtrend until you get this spike of volatility, right? So price runs up, takes out these highs, and then runs down, takes out these lows. This is a classic volatility expansion signature we see when you're at a higher time frame level. Um, we covered that in previous videos, but the idea is basically that, even though we're on an hourly chart, we're at whether you're on a 12-hour or a daily, a higher time frame level, being right here. And when that happens, when the lower time frames reach those levels, then you typically get this volatility expansion, and this is the area where, like, if you're too dialed in to the market, um, you may be right, you may be directionally right, but still stopped out, right? So you may have um, seen the break of this high right here, and then entered a long on a retracement with a stop below here, and ultimately gotten stopped out. So it's just an idea to, you generally want to enter after that volatility spike, um, if you're playing on this time frame, because again, if you're on an hourly chart, if you're not using this low to anchor your stop, right, it's really hard to. Now I have my stop down here, but that's sort of based off the 12-hour premise. So if I go back to this chart right here, let's see. Now I have my so essentially what I'm seeing here is you have this expansion of volatility, right, and then price cools down. It runs higher highs, lower lows, and then returns to the mean right here. And the price action following this area is very important because um, typically the where price continues from that expansion of volatility after the mean reversion is where you're likely to see continuation. And in this instance, you see price higher high, lower low, returns to the mean, and then it moves away from the mean above these highs right here. And that was kind of the framing for the entry of my trade. You can see it a little bit better on a 15-minute chart. And this is a Bitstamp chart. I'm not sure why I'm trading Bitstamp. The chart is not very clean, but you can see here this high was taken out. After this high was taken out, I just entered on a retest of that high. Now, I could manage a stop here. Um, I ultimately have my stop down here just because, again, this is sort of based off the higher time frame idea. I'm playing this level right here, so my stop is not exactly at this low, right? I want to give the market room to breathe. If it's going to do a stop run here, to run down to that level and then rally up. But the idea is I want to move my stop up pretty quickly if this trade starts moving in my direction. So I don't have the orders on the chart right now, but my first idea would be to take a little bit of profit off here. And now when price runs above these highs, then I would feel more comfortable moving the stop up to this low right here. And that's kind of just a progressive process that plays off. Um, I have this take profit right here, and then this take profit right here. Um, now, as price moves up, you already have this low set in place here, which could be used as a risk management area. But as price runs up and hits these distinctions, it will form new short time frame lows on the right side of the chart. And as each take profit is hit, those new short or low time frame lows can be used as swing points to manage a little bit of risk. Again, you don't have to get you know you don't have to go all or nothing. You can uh, say maybe you have maybe price runs up and comes down, sets in a short term low. Uh, you could use multiple lows to manage risk. And, in a lot of ways that would be it's more ideal just to not have a all or nothing view of the market. Um, but depending on your risk profile, that may or may not make sense. So ultimately, the idea in this trade is for, at least in the short term, is for it to price to run up, fill this gap or inefficiency. Because the idea was for it to fill it on the way down, but ironically, on the way down, it actually created new inefficiency just due to the nature of the move. So, I would reasonably expect um, this is kind of the area right here. This 43,000 area is kind of the area where I would look to have the majority of the risk on this trade taken off, and to kind of step back from the market and maybe return a little bit later and reassess. Just because it's a decent, once you fill that gap, it's a decent time to kind of take the profits away from the market, And if price is going to continue on and set new highs, which I'm a little bit biased to think that it will. Um, this is generally an area where price would pause or stall, and even if it does, mount a continuation move, there'll probably be plenty of opportunities to get in. So I'm not in a huge rush to make that breakout trade.